Welcome back, listeners. My name is Larry Colvig, founder and CEO of the Haven Financial Group. And if you're just tuning in, you're listening to the Haven Financial Group radio show, where we discuss crucial retirement and financial topics that really can make the difference between surviving retirement and thriving through it. And this week, we were talking about end-of-year financial refresher, kind of a refresher. What can we do? What should we do? The new year's coming. And we're glad to have Kyle Thomas, a certified financial planner, on with us today. Again, discussing all these things that if we're resonating with any of you that are listening, and you do have questions and worries, concerns, reservations, issues, don't be the type that says, well, I'm scared to come in because you guys, people, they're going to try to sell me something. That is the last thing we're going to do. We want to sit down with you and simply have conversations, ask you questions, you ask us questions about anything related to retirement. So if that's you, give us a call at 612-504-8400. Visit us online at havenfinancialgroup.com. The new year is coming. We have our calendar first quarter of all the classes. We're very big into education. We encourage you to come to any of our classes. What materials are provided, and we'll continue like we have for the last 10 years of educating in all these different areas, and we're hoping you can attend throughout the course of the year.
Absolutely. Again, that is at havenfinancialgroup.com. Be sure you check that out. And the telephone number is 612-504-8400. We want to talk a little bit about the value of consistency in retirement. Larry, we've seen pretty consistent markets in the last 6 to 8 months. But certainly that volatility can exist out there. And that's a frightening thing for somebody who is maybe within 5 years of retirement or in retirement right now. So let's talk about how you can stay consistent in your retirement with your savings and your investments. And, when we're talking about the markets consistency, that's a tough way to, it's tough to try to be consistent. So let's just talk a little bit about that, if we could, and how you advise people to remain consistent and still be in the markets.
Well, let's face it, when we're young, it seems like we have just eons and years and years and years to save for retirement. And that's kind of true. But, 20, 30 years, it's so far in the distance. By the way, if you can get started saving for retirement, do so now, because the power of compounding is very powerful. But what if you're 5 years or less, or maybe in retirement, which is who we talk to on a weekly basis? Many, many people in this range, 5 years or less, are in retirement. Now, what if the market's volatile? Right. I'm ready to jump off the cliff as soon as the market goes down 10, 20%. Maybe that means you're not in the right spot. So it's going to begin with the conversation of, okay, how much risk are you taking? Is it the right amount? Again, do you sleep at night? We talk about sleep insurance, or does the market keep you up? Are you the person that stares at the ticker tape 5 days a week and your day is ruined by either a good market or a bad market? Again, so many people are unaware of what type of risk that they have in their portfolio until there's major fluctuations. We don't necessarily think people need to be the expert, but they should have an awareness and an understanding of what they're doing, why they're doing it, and be prepared for the bulls and the bears, because that's what happens. The market goes up and it goes down. That's nothing scientific. It's what's been going on for years. What's different now is we're at a different season of life. How have we made some adjustments? And if you're doing exactly the same thing you did when you were 20 or 30, and now you're in your 60s, probably not in the right place at the right time. And that can be very negative at this stage of the game.
Sure, absolutely. Well, let's talk a little bit about, and Kyle, maybe you could chime in here and give me an idea of what you suggest for some of your clients to keep them consistent.
Well, what they say is consistency is key. And when we're talking about your investments and financials, it's not necessarily that the market be consistent. We want you, the individual, to be consistent. We want us, the advisor, to be consistent in our approach and our risk profiles, and making sure that we don't get emotional about our investments, because that's one of the things that we do is, we're kind of behavior coaches as well in investing, and just try to not be emotional, take that out of it, because that's when we can get ourselves into bad positions. And we pull out of the stock market when it's down in March of 2020, and then we miss out on the potential gains right there
Sure.
when it comes back for the following couple of years. So that's one of the big things, is just being consistent with our strategies, and that's what helps us to deliver positive performance and outperformance of the index. This past year for 2025, people who were with an advisor who was properly managing their accounts should have outperformed the indexes. And that's because we're consistently rebalancing and taking advantage of the volatility. We actually don't really want consistency with the market. We want that to be volatile, because that's when we can capitalize and create
Sure.
Better outcomes for everyone and our clients, because we're buying low and selling high. So we want inconsistency with the market, think of it that way, and then consistency with our strategy, and just making sure that we react timely and stay within our risk profile and not get too emotional.
Sure. It seems to me, though, again, when we start to think about consistency in the market, that's kind of the yin and the yang. But if someone would decide that they don't have the stomach for that, to play that game, as you were saying, sell high and buy low, annuities is another way, another place, right, to put their money to stay consistent, because they certainly would be that.
Yeah, I would say I'll chime in on this one. Because we're dealing with those that are close to retirement, in retirement, and those accumulation years are dwindling or they're gone. We're big into having good liquidity. You've heard me say it many times. Adequate liquidity, cash in the bank, very important, and most people don't have enough. Money in the stock market, absolutely, if it makes sense. And maybe some investments that have principal protection, or maybe a bond replacement. Something for the person that's listening that says, I don't want to gamble with all my money. I want some protected. I'm willing to give up some of the upside for no downside risk, and maybe necessarily no fees. Now, you can go to my website. I think first quarter, there's a class that I'm teaching the truth about annuities. I teach it 3-4 times a year because I want people to be educated on annuities. Number one, there's lots of misconceptions. There's lots of financial marketing out there. You have to be careful, which is why you want to do your research and understand, well, does an annuity fit into my portfolio? Does it make sense? There's 4 types. There's immediate annuities, variable annuities, fixed annuities, and fixed indexed annuities. And 2 of them are very different than the other 2. Annuities aren't for everybody. Nothing should be for everybody. Problem is, I see a lot of folks, they have them, they don't know which one of the 4 they have. That could be a problem. There's some that have exorbitant fees. That is a problem. There's some that are not protecting your principal. That can be a problem if you think it's going to protect. Some people have been sold some of these, and unfortunately, they've been sold a bill of goods because, let me put $100,000 in. The market goes down. All my cash balance is say 80. Now you're stuck. Now what you got is a death benefit. Yeah, but I didn't do it for a death benefit. I've heard this so many times in all the years that I've done this. So having a good understanding, get educated. Why does it fit? And I know Kyle would agree, as one of the certified financial planners on the Haven investment team, it can be very beneficial for income, or it can just be for use for accumulation purposes. And by the way, they don't have to have any fees at all.
Right.
And if that sounds intriguing, give us a call, come on in. Or if you're listening and go, wow, I think I have one of those annuity things, whether it's IRA, Roth IRA, or a non-qualified annuity. Maybe you should have an annuity exam or annuity x-ray so you at least understand what you have, knowing you might be stuck and might not be able to do anything different. I just had somebody in this week. 6 months ago, they did a very, very large annuity. It wasn't the one that she thought she had, and she stuck for at least 3 years. And the outcome is going to be, did you know you're paying 3.5% in fees? No. Did you know you could lose cash value? No. So she was completely sold a bill of goods. And I hate to see that 3 years from now. we'll be able to help her. But again, sometimes there's nothing you can do.
Well, that's consistency you don't want in your retirement, to
Exactly.
be honest. So, yeah, we're talking about consistency in your retirement. Obviously, um, sometimes you need a partner to help you get your affairs in order so that they are consistent. If that is you, give the folks at Haven Financial Group a call, 612-504-8400. Coming up next, we're going to talk about Social Security. Now, that's something that's consistently in our lives. We're either paying it or maybe we're drawing it. But we're going to talk about where it all started. A lot of people always concerned that Social Security will not exist when it's time for them to start to draw. So we'll get these two experts' opinions about that and talk a little bit more about the history of Social Security. You're listening to the Haven Financial Group radio show.